Good afternoon, everyone, and welcome to the launch of our 2026 Alterna Wealth webinar series. My name is William Evelet, Director of Wealth Management here at Alterna, and I'm thrilled to kick off what we believe will be our most engaging and impactful webinar lineup yet. For those of you who've joined us in previous years, you'll notice something new today. Historically, these webinars have been led by the same familiar voices, and they've done a tremendous job at building the foundation for the series. This year, we're shaking things up. We're bringing in new perspectives, new presenters, and a wider range of voices to keep the sessions fresh, relevant, and aligned with the realities that you're facing as investors. And don't worry, of course, you'll still see Doug Carroll and hopefully Mike a few times this year. Now, bringing in new voices is just one part of how we're elevating the series. We've also taken a fresh look at the overall design of our webinars to make them more relevant, more engaging, and more closely aligned with what you've told us matters most. And here at Alterna, we know that financial confidence grows from things like ongoing clarity and support. And that's exactly what the redesigned webinar series is built to deliver. So we're always listening, and we always welcome your feedback as we continue to strengthen these sessions. One thing I'd like to emphasize today is that these webinars aren't just for existing Alterna members. If you have friends, family members, or colleagues who would benefit from these insights, please feel free to share the invitations with them. The more people we can help move towards financial confidence, the better. Now, before we get started, just a few quick housekeeping notes. Today's session is being recorded, and you will receive a follow-up email with the recording and a brief survey. Please use the Q&A button at any point in time. You will find this at the bottom of your screen, as we have dedicated time for questions at the end. We'll be together for just under 1 hour, and we encourage you to stay for the full session if possible. And lastly, please keep an eye out. Our February webinar invitation will be going out next week. Now, to help us set the tone for 2026, we are joined today by an exceptional speaker, and I'm delighted to welcome Ghislain Maillet, Executive Director and Client Advisor at JP Morgan Asset Management. With over 25 years of experience, including more than 2 decades with Fidelity Investments Canada, Ghislain is widely recognized for his ability to explain complex economic forces in a way that's accessible, engaging, and actionable. He holds a master's degree in economics from the Superior School of Commerce in France and a bachelor's degree in accounting from the University of Moncton. He is a gifted communicator and a respected voice in our industry, and we're very fortunate to have him kicking off our 2026 webinar series. Ghislain, thank you for being here, sir. The floor is yours.
Thank you so much, Liam, and it's a pleasure to be here. Thank you all, and congratulations for taking the time to find out more about what's going on in the world of macroeconomics. As presented, it's truly a specialty and a passion of mine to follow everything that's going on in the markets, in the economy. And I would argue there's always something to talk about. We are in the eternal chess game of markets, and there's many ways to look at it, many ways to play it. But there's certain truths and certain lessons that I've learned throughout time that stay true through time, and we'll try to share some of those with you as well. This presentation will be quite visual, but let's not get lost in the complexity of certain of the slides, because I hope the message comes across simpler than some of the charts at JP Morgan that can be quite rich in detail. We're going to cover a series of different topics. That doesn't cover it all. I think there's a chat button where you can put in some questions. We're going to try to save some time at the end for questions. I know many of you have already put in a lot of questions. We've reviewed it before this presentation, and I'm happy to report that we're going to cover a lot of these, and hopefully we'll cover the rest with Liam's help at the end or throughout. Okay, so let me just set the stage with a lesson of 2025, or a conclusion. Now that 2025 is done, the big conclusion, and it's good news, diversification is back. For many years in the last decade or even 15 years, the stock market has been, in terms of performance, has been dominated by the US equity market, as we can see at the left of this chart, looking out 15 years in the past. Again, in 2024, the US was leading the pack and the rest was following. But there was a pretty dramatic reversal in 2025. Now, many things contributed to that, including the currency. But if you look at the order of who led and who didn't, at the bottom of the right side of this chart, you can see Euro zone was number one, Canada was number two, emerging markets and Japan after, and US still with a very healthy Canadian dollar based return of 12.4% was at the end. Now that's happened in the last 15 years, but not often, but it is counter trend. So that's one way to look at it. But we can also talk about bonds having a good year as well for conservative investors. Basically, when we look at 2025, if someone took a diversified approach, and that could be defined by a 60% portfolio into stocks, ownership of companies, and 40% within bonds, which are guaranteed instruments that pay the investor an interest income, the combination of both of these, if it's globally diversified, had almost the same rate of return as the famous S&P 500, but with less than half the volatility. It doesn't get better than that when it comes to diversified return. Our view looking into 2026, and we could already attest to that since the beginning of the year, diversification is working again, and we think it'll keep working. And that's welcome news for your advisors at your firm, because it's been challenging to prone diversification, to have a discipline towards diversification, yet there's one asset class, one region that constantly steals the show. That dynamic is changing for the better of diversification. So that's the first thing I'd like to put up there. And we're going to fill up this chart with opinions, calls, views, outlooks. And the next one is looking forward into 2026. Financial conditions are supportive. Governments and central banks are easing financial conditions. Now, this goes into a topic of high finance or microeconomics that we could get lost in the different terminology, but we're going to try to keep it simple with this visual before we get into a few charts. Pretend this glass of water is all the different investments you could possibly find, but I'm limiting it to the best investments long-term. And the best investments long-term is being an owner of a profitable company that passes the test of time. Real estate is also one of the best investments long-term. Outside of productive assets, you could say gold has been a very good asset class recently, and Bitcoin since it's been around, although quite volatile. But let's say that represents the opportunity set of where you can put your money, and everyone's money can be invested there. This jug of water represents the source of money that can invest in the market of assets. My first point looking out in 2026 is that we remain in a very favorable backdrop of supply and demand for assets, meaning the supply of assets is limited and the potential demand to buy those assets is unlimited, because governments, through what's called fiscal and monetary policy, literally can provide unlimited liquidity to the economy. When a government spends more money than they collect in taxes, that's what we call a deficit. A deficit is often portrayed, depending on the article, by some journalists as a negative thing, because longer term, if a country runs a deficit that's too big for too long and accumulates too much debt, it will eventually handicap their ability to address certain issues or certain reforms. But if you're an investor, and this is an investment webinar, a deficit means fresh new cash being created and injected into the economy. When a government creates cash through a deficit, that money is injected in the economy, let's call it a glass of water, sometimes surgically to stimulate parts of the economy, or sometimes a blanket type of generosity like we saw in COVID. But But once the money, like they're doing it for political reason and economic reasons, maybe social safety nets. But once the money is in the economy, it's free to go wherever it wants to go, from hand to hand, eventually falling into the hands of an investor or a saver. A saver would place that money in something secure. An investor would exchange that money for a productive asset. And that's where the other side of this supply and demand comes in. We live in a world of limited assets. By limited assets, I mean, if I talk about public equities, we're talking about stocks on the stock market, whether it's Canadian stocks, US stocks, global stocks. I'm going to focus on global stocks for most of this presentation, but we could talk about Canada as well. But let's look at the US. I started my career 26 years ago or so. There's 30% less stocks on the New York Stock Exchange today than when I started. That's the number of stocks that are available for investors to buy. But when it comes to how much money can buy stocks, well, the float of money since the last 25 years has dramatically grown. So that's what I mean by favorable financial conditions. I'll go a little bit further. There's 30% less stocks in the New York Stock Exchange today than 25 years ago. But of the most profitable companies, some of the magnificent companies and others that have recurring profits every year, they're actually using a portion of their profits to buy back their existing stocks. These share buyback programs, for those that are students of the markets, you know it's good news when it's announced, has been going on for years. So there's less companies that are listed in the stock market, and there's less shares of these companies available for you to buy. Yet, there's more and more US dollars in the system. There's more and more Canadian dollars in the system. There's more and more euros. There's more and more yens, yuans, and all the different currencies you can imagine. If you didn't guess it, the sun is shining on me right now, and I will quickly
I thought you were just glowing.
It's glowing. The future looks bright. But on this first point, what I want to put forward is we are still in a favorable supply and demand dynamic for assets. Now, I only talked about fiscal deficits, but I could say similar things when it comes to monetary policy. Central banks can also create money and inject them in the system. So by using this chart of the S&P 500, I'm just going to go back in time and explain a couple of times in history when there was a sudden injection of new capital to take care of a problem. QE1, that's an acronym for a term called quantitative easing, but what the media likes to call it is money printing. So in 2008, we were in a very deep financial crisis. And it was a good idea to inject a lot of capital in order to get that engine, like oil, to get it humming again, to get it rolling again, and to get confidence back so that the economy gets back on a better footing. It totally worked. The economy did pick up again, so did all types of investment activity. And actually, a couple of years later, there was another round of money printing, and then another one. Questionable if we needed these second and third round. But the result of which is that central banks, especially the Fed when it comes to 2008, printed a lot of money, injected that into the system. It worked. And despite the fact that I was doing presentations in early 2009, and when that was happening, the main concern of people in the business or not was, oh my God, with all this new money, isn't this going to create inflation? Won't the value of every dollar go down? And it was a principal concern. Inflation is always a constant. There's always some inflation, but it did not pick up as much as many people feared. Now that gave the central banks of the world a little too much confidence. So when COVID showed up, there was another round of money printing from central banks and a lot of generosity from governments through fiscal spending. spending more than what we collect, or deficits. Rich with the experience of 2008, where you could print a lot of money and fix a lot of problems and you don't have that much consequences. They went much further this time at the offset of COVID. But this was also married with a supply chain disruption. So supply was disrupted by the fact that we had to physically close down the boutiques around the world and flow of people and products slowed down. At the same time, as the economy was faced with tremendous new amounts of US dollars, Canadian dollars, euros, yens, yuans, you name it. If you create a dollar and you put it in someone's pocket, you don't create a gas for them to buy or food for them to buy. You just create demand for all that stuff. So in this occasion, it did create inflation. And central banks had to react. They did in 2021, 2022 by raising interest rates, which is an effective way to calm down inflation. It did calm down inflation. People don't feel good about it because these heightened prices stay. They just stop going up as fast. And now with Trump's election, and the OBBB is the one big beautiful bill that was passed into law July of last year, we are now facing another round of heavy injection of money in the system. In fact, one big beautiful bill nearly guarantees a high level of deficits in the future. So we're not going to get lost in here, but on the left side of the left side of this chart, you've got all the spending of the federal government. On the right side, you have the sources of income, and you have a deficit of $1.7 trillion. On the right side, top right, you have the deficit in percentage of the total economy. We're around 6%. When you go back in history, and even further back than 1973, and you look at levels of government deficits, today's level of deficit is comparable to when you were in either a deep financial crisis like 2008, or you're trying to fight the consequences of COVID in 2020, or World War I and World War II. Today, in the US economy, we are in neither of all these scenarios. We're not at World War. We're not in a deep financial crisis. We're not fighting a pandemic. Yet, there's a heavy level of deficits. To put that into concrete numbers, in this quarter and next, if you look at the bottom right side of this chart, the average American is going to get a tax refund that is quite, well, 1,000 to almost 2,000 more than historical average. And that's an average. Some people will get a big refund, some people will get less, but the average American is about to get a sugar high of tax refund, in large part due to the big, beautiful bill. So that's a lot of talk on monetary supply and demand, but I'll come back to the point. As much as we can be inundated by headlines that are worrisome as citizens, a lot of geopolitical stuff is really not fun, and it can affect confidence as an investor and even as a consumer. But to be a great investor, you have to, it's better done with little emotion and a focus on the numbers. And when it comes to the numbers, I'll wrap it up with this. We're going to finish 2026 with an economic system that has way more cash in it than today. Some of that cash is going to find itself into the most profitable companies in the world, and that is a tailwind for stocks, real estate, and assets that pass the test of time. That said, we're not going to avoid the elephant in the virtual room, which is all this noise and political ramifications of if I can quote our prime minister, a changing or ruptured world order. What a speech at Davos. I listened to it last night. We could have a whole presentation just on that speech. But there are changes in the air when it comes to geopolitics and politics. But it's important to make the difference between noise and actual signals. And more importantly, it's important to separate politics and markets because they're not necessarily synchronized. Politics, all that noise can affect consumer confidence. We're seeing it in the polls or in the surveys. This crazy chart is the ups and downs of US consumer confidence through time. You can see sometimes people feel great, and you can see other times, like today, they don't feel that good at all. That could be misleading. If you're reading a lot of articles of people feeling really bad about the economy, like a lot of people in Canada feel bad about the Canadian economy, like it's the worst economy and it's been in the it's in a tough spot. Well, reality of numbers is not always what people say and feel. We created more job in the last couple of months than the whole U.S. economy of all of last year. Our unemployment rate is going down. The U.S. economy's unemployment rate is going up. So you got to stick to the numbers. When it comes to this consumer confidence, it's actually quite counterintuitive. It's a reliable it's not a guarantee, but it's been quite the reliable contrarian indicator to stock market performance next 12 months. And the numbers are in blue. If you look at this chart and you focus on the bottom side, when consumer confidence in the US is low and at the trough, for example, February 1925, confidence was quite low. We were in the second round of an inflationary spiral. Yet, the next 12 months, the stock market was up 22.2%. In 1980, confidence was quite low because they hired a central banker at the Fed called Paul Volcker with the mandate to crush the economy in order to crush inflation once and for all. Because the 70s was a whole period of spiraling inflation. Well, 12 months after, the US stock market was up 20%. And we could keep going. 1990, market was up 29% after that. 2003, market was up 32%. That was not a fun. That was the beginning of Iraq war. There was all kinds of stuff going on. So I could go on and on. The last time we had a trough was June 2022, when we realized all the mortgage rates are going to get much higher. This is definitely going to create a recession, which didn't happen. Markets were up 17.6% after that. So, first point, let's separate feelings and press and social media and memes and what you think is going on with the reality of the stock market. It follows earnings. And companies are incredibly good at adapting to all kinds of conditions. So, yes, US politics is concerning. Now, I know politics implies that some people like the policies and other people's don't, and that is freedom, that is democracy, and that is fine. And some people like what's happening, some people don't like what's happening. My point is that whether you like it or not, it's not as important as some would suggest when it comes to the actual health of the companies that can be within your portfolios. Earnings have gone up 11% last year with all of that worrisome news, Liberation Day. We could go through a whole roster, a whole list of headlines, which in itself could have been concerning. Yet companies, well, actually, consumers kept consuming and companies kept collecting revenues. And on that point, let's dig deeper. Geopolitics, there's always something going on. I would argue there's been time in history when it was much worse than today, the world wars, etc. But still, a lot of people feel rightfully so concerned with a lot of things that are going on. But let's get back to the fact that this is an investment webinar, and let's do an exercise. I'm going to ask you a question, and you can answer yourself in your mind. The next time you read an article that's quite worrisome, recently it was Greenland, but now in Davos, Trump kind of walked that back, so we got good news. But let's say the next time we get bad news from Trump or something, someone else or somewhere else. Ask yourself the question, what will you do differently that day, that week, that month as a consumer? I would argue you're probably going to do exactly what you were going to do, even if you hadn't read the news. You're probably going to get to work, probably get back. Maybe you're going to fill up for gas or plug in your car. You might stop, get some food. You're going to pay your phone bill. You're going to maybe book a vacation down the road, maybe not in the same area where there's geopolitical risk, but the fact that we read bad news and it creates a certain feeling doesn't necessarily change your habits as a consumer. And that's why there's a pretty big disconnect between bad news and geopolitics and politics and the health of businesses, which at the end of the day, they're there to provide a product or a service for people that want it or need it at a profit. And that continues. Looking into 2026, the earnings estimates is that it will rise relative to 2025 at 15%. And then in 27 at 15% on top of the 15%, compounding that earnings growth. That's for US companies. We were talking before the show. We have some young kids and they went to kindergarten and they're bringing in a lot of virus home. So excuse me if I take temporary breaks and a glass of water. But to come back to earnings, that's one of the most favorable news from JP Morgan looking into 2026. And it is more powerful than the first good news, which is favorable supply and demand for assets. Now, earnings estimates can evolve, things can happen, it's not guaranteed. But when your starting estimates are at 15%, and by the way, at the beginning of 2025, starting estimates were at 10 and they finished at 11. But often they could finish lower. But when you're starting from that kind of a higher base, it's quite supportive, especially faced with an American stock market that is expensive. And some of the questions that were asked before this series, are we in a bubble and how bad the crash is going to be? It's a valid question because the word bubble is getting thrown out there a lot. Well, when it comes to JP Morgan, we are not part of the school of thought that thinks there's a big bubble currently. There's certain parts of the stock market that are bubble-ish, quantum computing, fusion energy, a couple of AI stocks that don't actually have an AI business yet. But the serious companies that are investing massively in artificial intelligence, in large part with their free cash flow that they're generating, I'm referring to some of the hyperscalers, the Mag 7 companies, we do not see a bubble there. We see a fully valued stock market, but we also see full support from growing earnings. So when you're a great company with a balance sheet, like some of the balance sheets of the bigger companies in the US are stronger than most governments of the world, and their profits are like that 15% earnings growth is an average of the 500 companies in the S&P 500. The Mag 7 earnings are going up by, on estimates, 23% in 2026, and the rest is lower in the 12s. The point of that is that they're expensive companies because they're magnificent businesses. And we can see it here. So I said 24% for the Mag 7, and do I have a little cursor here somewhere? But if you look at the bottom left side, year over year earnings growth, the green is the magnificent 7 companies, and the blue is the rest. Now, on this, I said at the beginning, what we noticed in 2025 is that diversification is back. It's also true within the US stock market. If you look at the right side of this chart, 2023, all of the Mag 7 companies outperformed the index, meaning that if you weren't in those companies, you underperformed for sure. 2025, near all of them. Sorry, 24, near all of them. One didn't beat the S&P 500. In 2025, only NVIDIA and Alphabet outperformed the S&P 500. All others underperform. Year to date, the Mag 7s are on a timeout. So what we are witnessing for the last quarter and year to date is a rotation or a broadening of market leadership within and under the S&P 500. This is a very healthy behavior, and it's fueled by earnings growth. Now, okay, I'm going to use terms here at the second derivative. Here's what I mean. Stock markets take their leadership by the direction of earnings. If earnings are on the way up, there's a high likelihood the stocks are on the way up as well. But it's often not the earnings level, but the earnings steepness. What we are forecasting, and the street as well, for 2026 is that the 493 companies outside the Mag 7, their profits are starting from a lower level, but they're accelerating faster than the magnificent companies that have a higher growth rate. But at the second derivative, it's still growing high, but not faster. So the point of this is that we might see a broadening of market participants in the S&P 500, and that's great if you're a diversified investor. The other thing I would say is that artificial intelligence, and we're going to talk about this. I'll get back to this. It's a transformational boom. We are in the early innings of a technology that's going to have revolutionary effects on the economy. Not evolutionary, but revolutionary. It's going to be transformative. It's going to displace some jobs for sure. It's already starting. It depends how fast it goes. It depends how deep it goes. We can't know all of that in advance, but we know enough about the technology to believe that it's quite consequential, and it requires a lot of our research capabilities at JP Morgan to properly understand who will be the winners, who will be the losers, and invest accordingly. And there will be emerging leaders, like every 10 years, there's new companies that come into the picture. But let's touch on artificial intelligence. We'll start with an image. This is the result of the Apollo project. It costs a series of governments, but mostly the US government, $250 billion US dollars in today's dollars over 10 years for the Apollo project to bring humans to the moon. Back then, it was seen as way too expensive and a very big undertaking, but it's part of our history, and it's something great. It pales in comparison to how much money is going into AI data centers. Just in 2025, you'll see the first gray column here, $400, not $400, it's $400 billion. And this is just from 5 American companies. We're calling on the AI hyperscalers: Alphabet, the parent company of Google; Amazon; Meta, the parent company of Facebook and Instagram; Microsoft and Oracle. If you look at the world level, at other companies, at other governments investing in AI, it's closer on estimates to $1.3 to $1.4 trillion of capital expenditure to build these data centers with very powerful computers in order to generate artificial intelligence to be used by humans, by corporations, by governments for multiple different ways. With that level of investment, and there's no parallel in history for this level, relative to the size of the economy, like you could look at the Manhattan Project to invent the nuclear bomb. It pales in comparison to this in terms of size of investment. You can look at railroads. You can look at electrification at the offset of electricity. All the infrastructure when it comes to generating or distributing oil pales in comparison to what's happening here. So that level of investment will have a lot of impact, and we will be talking about this for many future series, and we have to work a lot on this. The reason we don't see it as a bubble compared to the internet bubble is that at the peak of the bubble, this is one example, there's others, but at the peak of the internet bubble, 94% of the fiber optics that was placed around the world to connect all the computers, hence the internet, was dark. It's called dark fiber. There was no data going in. There was no light in the fiber optics. It was over capacity. We eventually used that capacity, but it was too big, too fast, too quick. Right now, that's not what we're seeing. It's the opposite. 97 to 98% of all GPUs from NVIDIA, from AMD, from others that are put into a data center instantly get used. It's such a boom that the growth of computing power related to artificial intelligence is more likely to hit a physical limit than a financial limit, because there doesn't seem to be an end to this appetite to invest. It's like a race. So because the requirements of energy of these data centers are growing exponentially when power generation, especially in the US, is growing at roughly 3 to 4%. So right now, only China is growing power fast enough to match the growing demand of their growing data centers. So this built out is estimated to keep growing in 2026 and 2027, but there will be a time where it slows down. Let me just look at the time. Okay, we're going to try to bring it in. Now, companies are investing in AI, but a lot more companies that don't invest in AI will use AI. And a lot of people like you are already using it. When we're talking to all the different companies around the world, it's pretty clear. They either already implemented AI to help reduce costs or increase revenues, or they're working on the next model or next part of the business that can be implemented. Some have already measured results. Many have yet to see a measurable return. So we're still early innings on quantifying the rate of return of all that CapEx, so that in itself is a risk, and we should question that. But at the end of the day, the longer you look at the application of it, the more it's clear that it will have a return for companies, just like anyone that's been using AI sees a productivity return for themselves. Basically, if we want to keep this very simple, the way we see it is, well, when I started in the business, this wasn't a thing. There was BlackBerries. Not everyone had them. They were ugly. They didn't do a fraction of the stuff that this does. And yet, we are now at a place where most humans have one of these, and most humans couldn't imagine not having one of these. We've become dependent on it. And it wasn't that long of a period. It's quite predictable for us that we will all have artificial intelligent agents, and maybe multiple, all of us individually, and we will get to a point where we're quite dependent on it. Same for corporation. And it's quite predictable as well that companies will find a way to monetize that massive usage rate around the world. So it's just a question of time. If it takes too much time, well, maybe those stocks, maybe the timeout we're in for Mag 7 is just that. We want to see the return before we celebrate more of that success. Our 5-year view. Well, when it comes to market leadership, we see a broadening of the leadership. So basically, it was all the US the last 5 years. It wasn't like that last year. There's reasons to believe that Canada, international markets, emerging markets can hold their own relative to the US stock market. Now, not everyone at JP Morgan is willing to say Canadian stocks or European stocks or Japanese stocks will outperform American companies, because there's pros and cons. The best part about international markets is, despite their outperformance last year, including Canada, they're less expensive than American companies. So that's the positive. There's others, but that's the main positive of stocks outside the US. But the main positive for US companies is that they are exceptional at performing, meaning higher returns of equity, chronic through time, very quick to adapt and apply new technology. If there's one place in the world that companies are going to be quick and aggressive to apply AI to save costs or generate more revenues, it's the USA. So as much as I understand Canadians with everything's going on, you know what? Maybe I'll travel a little bit less to the US. Maybe I'll invest a little bit less in the US. I think we shouldn't go too far on the investment part. Personally, I think the US should be the biggest part of someone's diversified portfolio, but that's a personal That's up to you and your advisor, and that's totally personal. Um, and we shouldn't confuse the health of a company with the health of a political system, because they can be quite different. The other thing I would argue is in the last 5 years, bonds didn't do well at all, because when interest rates went up, the price of bonds went down, and it was a rough go for conservative investors. While aggressive investors that are mostly in stocks did okay. They have to accept the package deal that is the stock market. If you're going to invest in stocks, expect volatility, accept volatility. Even better, celebrate it when it happens by buying more, because it's an opportunity every single time. That's the one thing I learned in 25 years of working in the markets. We're going to have a crisis. You're not always going to be able to predict it. Most of the time you won't, even if you're a professional in the business. It's going to hurt confidence. Stocks are going to go down. You're not going to feel like investing. And every single time was a great time to invest. So that's the package deal. It's a stomach thing. It's not a mind thing. Okay. But the way we see the mathematics of the stock market being expensive and the interest rates on bonds being not rich, but decent, the next 5 years, we do believe stocks will outperform bonds, because that's what they do long term. But the difference is going to be much more narrow. We believe a balanced investor, well, balanced investment for most people, even at retirement, is the way to go, especially with today's mathematics. So yes, long-term stocks will do better than bonds. Next 5 years, we're not sure it's a whole lot, like a lot more like the last 5 years. We really think it's also a good time to be prudent. And the best way to be prudent is not to panic and not invest. That's not prudent at all, because you want your money to outwork inflation. So you have to have the money at work. But since diversification is working this well, I would argue make it diversified, work with your advisor to make sure you're diversified, and keep it that way. And I would argue rebalance more often. I'm just going to share here. We're in an environment where, even at the index level for bonds, you can expect a decent bond manager can outperform the bond market. Final thoughts before we take some of the questions. Long term, as much as we prone diversification, and today the math for a diversified portfolio is good. The dynamics of the markets for a diversified portfolio is good. The 60-40 portfolio is not dead. It's back. Last year was a great example, and year to date is another good example. That said, if there's people that are younger in this virtual room, or if you have kids, or if you're young at heart and you don't overly worry about headlines. The other thing I've learned is that if you're truly a long-term investor, meaning, well, by long-term, I mean at least 5 years, but ideally 7-8 years or more. Okay, but at least 5 years. If you don't need your money for at least 5 years, and you accept the package deal that is stocks, it's not a straight line. Never has been, never will be. If you accept that, you're far better long-term being an owner of profitable businesses than a lender of your money for an interest. So I really think most people should be diversified. But if you're going to tilt one way and you have a long-term perspective, despite all the bad news we're going to be faced with in 2026 and beyond, people that just accumulate shares of profitable companies and just let them do their work through time without losing sleep over it when you have a bad quarter or a bad year, tend to end up on top, as per this chart suggests. But for most people that can't handle being strictly a business owner and having that much volatility, diversification does work. The longer you look at it, the more it mitigates the worst years or the worst events, and you end up compounding at a superior level than any country's interest rate. I'll wrap it up there. We're at 45 minutes in. That's a lot of stuff. So final thoughts is stay diversified, stay patient, and despite all the news, stay positive. Trump is temporary. The bad news today is not going to be the same bad news in the future. And companies can outlive any politician, and that's what you can own in your portfolios. Liam, that was for the prepared presentation. Any questions?
Ghislaine, thank you for such an energizing start to our 2026 webinar series. I feel like I've got a really clear understanding of the forces shaping today's markets. I hope that everybody in the virtual room does as well, and hopefully a stronger sense of how to navigate the year ahead. Let's take a brief moment or two to go through some of the questions we've received from participants. Depending on time, we'll see how many we can get through. The first one I've got for you is, which markets, if any, have the potential to outperform the North American markets?
At JP Morgan, we think there's a pretty good setup for emerging markets. Now, emerging markets is not for everyone. Emerging markets is a high risk asset class. Emerging markets can fluctuate a lot. Emerging markets require, in our view, active management. Like, you can be passive for the US stock market and certain things. You can be passive with gold. You don't want to be passive with emerging markets because a lot of companies are controlled by governments and they don't have the shareholders' best interests at heart. But solving for good selection of stocks in emerging markets, by emerging markets, I mean Asia, China, the Asian Pacific corridor to Australia. Now, Australia is not emerging. India, Latin America. So it's a combination of two things. One, it's the cheapest part of the global stock markets by a wide margin. Two, if you're coming from a developed market with your developed currency, you can buy a lot of these currencies in developing currencies, so you have a currency benefit. Three, earnings are pointing up and growing faster than anywhere in the world. So if you have the cheapest stock market, cheap currencies, and quickly growing profits, it's a setup for a higher rate of return. I'll add to that two things. It's been in a very difficult spot for well over a decade, and there's green shoots of technical positive signs that this market is waking up. It did outperform every market out there last year. That doesn't mean or guarantee anything for this year, but it means despite the outperformance last year, it's still cheap. And it has legs in our view. But if you qualify for that, because not everyone should qualify for that, it should remain a small portion of your diversified portfolio, in our view.
Love that. Thank you. The second one we've got here is the Canadian dollar going to go downhill as Canadian oil loses out to Venezuelan oil?
Oh, that's loaded. Okay. We don't believe so, and we're not worried for the Canadian dollar, nor for that reason. Okay, so how do I unpack that? First of all, so Venezuelan oil is underexploited. That their own people in a better political system could better use that opportunity to export that oil to their benefit. But to dramatically pick up oil production in the next couple of years, well, actually, you can pick it up a little bit, not enough to move the needle with current infrastructure. You would first need to invest massively in infrastructure. And who's going to do that? Who's got the expertise in dollars? The big oil companies. What have the big oil companies said to the White House a couple of weeks ago? It's uninvestable. It's unstable. You need a lot of stability and confidence that you could go into a country and invest billions of dollars for a rate of return that won't come for 8 to 10 years. You need a lot of confidence before you put a lot of money in infrastructure for a 10-year plan. And then your rate of return is over 20, 30 years after. We are not at a place in Venezuela right now where there's enough stability and confidence for any meaningful investment to compete with Canadian oil. And American refineries are specifically geared, most of them, for Western Canadian Select oil. So there is competition. Venezuela can become a player longer term. A lot of things have to go right before that happens. But even that, oil aside, the Canadian dollar is not a commodity currency as much as it was before. The size of the oil, the impact of oil to total GDP is not as big as before. The correlation between oil and Canadian dollar is not as strong. So it's not all about oil, basically, is what I'm saying. And the other part of this is that what influences the Canadian dollar more short term is a term in finance called the interest rate differential. Now, what is that? It's our interest rates in Canada relative to the interest rates in the US. Right now, their interest rates are higher than ours, creating money goes where it's better treated. So if you just look at that, it attracts more money to the US because it pays a higher yield, interest rates. But the Bank of Canada has already cut and reduced interest rates to a level that JP Morgan believes is quite sufficiently low. And they're probably on a timeout because we're having surprised positive economic news coming out of Canada at the same time as we're seeing weakness in the US job market. So, which means we believe the Fed is going to cut rates in 2026, and there's a good possibility the Bank of Canada does nothing. So, that interest rate differential, in our view, is set to narrow. Relatively speaking, that's better for Canadian dollar than US.
Okay. On the topic of Canada, maybe we'll wrap it up with one last one here. Totally valid position the question's coming from. Is another depression possible in Canada?
Oh, everything is possible. I would argue it's highly improbable. And that's true not just for Canada, for US, for most of the world. We're living, I'll come back to the first topic here. We're living in a world where there is no fiscal responsibility anywhere. It's not just Canada. It's not just US. It's not blue. It's not red. We live in a world where, independently who's in charge, they're finding reasons to spend more than they're collecting in taxes. So when you have especially with today's geopolitics, unfortunately, this is the saddest part. We lost the peace dividend. Everyone is spending massively on defense. That's very expensive stuff and it's long-term stuff. So we're in a dynamic with governments that every election is existential. It shouldn't be. And every politician is trying to outspend the other. And Carney is going to be spending a lot of money. Now, I believe, personal opinion, not JP Morgan, but I believe Carney, with his background, has a higher likelihood of having that spending being way more protein than Trudeau did for the last many years. Or way more protein-ish, so investments that have a return for the economy long term, than what Trump is doing with a big, beautiful bill. But the fact that all governments are spending that much reduces the likelihood of recession, let alone depression. And even if we have a recession, which is always possible, it tends to be quite shallow because governments are so generous with spending. So I think the likelihood of even a recession is low, let alone a depression. But the likelihood of a sluggish economy, well, we're there, and that could remain like that for a while. Because Canada, just like the US, we've stopped immigrating. Not the same way, not the same orchestration of immigration policy, but immigration has come down a lot. So economy is humans times their productivity. We are growing our human count much lower in 26 than the last couple of years.
Ghislaine, thank you so much for answering the questions. Thank you for the great presentation today. At Alterna, our goal is to, as you know, to help members move from uncertainty to clarity, from good intentions to confident financial action. And webinars like the one that you helped us run today are, of course, a super important part of that. But the real value comes when these insights are applied to personal financial plans. So if today's discussion And presentation from Ghislaine sparked new questions we might not have gotten around to during the presentation, or if you're thinking about how to approach your investments more intentionally this year, I really encourage you to connect with one of our licensed advisors. They're here to help you build a personalized plan that aligns with your goals, your timeline, your vision for the future, whatever that may be. You can book an appointment directly at alterna.ca/wealth or reach out to your local branch, and they'd be happy to assist you. Once again, these sessions are open to everyone. If you know someone who would benefit from these insights, please share. Please feel free to invite them to our upcoming sessions. Thank you again for joining us today, Ghislaine. Thank you. This is just the beginning of an exciting year of education, insight, and growth. We really look forward to supporting you on your financial journey. And of course, we hope to see you at our February webinar. Ghislaine, thank you. And everybody else, thank you so much. Take care.